Silver and gold just had a huge breakout, and almost nobody is talking about the real reason why. CPI numbers are dropping this week. Iran is back in the headlines. COMEX inventories are shifting in ways that should worry every serious investor. And China just made a move that changes everything. 4 separate signals, hitting the market at the exact same time. This has happened before in history. And every single time, it meant something big was coming. The question is not whether this breakout is real. The question is what happens next. And by the end of this video, you will understand exactly what these 4 forces mean for your money. Stay till the end, because the final piece of this puzzle is the one most people are missing. Welcome back to Currency Arc Insight, the channel dedicated to decoding the economic signals that shape global wealth. If this is your first time here, subscribe now and join a growing community of serious investors who refuse to be caught off guard. Drop a comment and let us know which country you're watching from today. On the morning the alert went out, silver and gold did something that caught the attention of serious market watchers around the world. Both metals moved sharply higher within a short window of time. For the average viewer scrolling through headlines, it looked like just another price spike. But for analysts who study market structure closely, this was something different. It was not noise, it was a signal. To understand why this matters, it helps to look at how major price breakouts have behaved throughout history. A breakout is not simply a number going up, it is a shift in the underlying balance between buyers and sellers, one that often reflects deeper forces building beneath the surface long before the price move actually happens. When gold and silver break through resistance levels that have held for months, it usually means that pressure has been building quietly, and the visible price jump is only the moment that pressure becomes impossible to hide. This is why analysts describe the current situation as a confluence event. A confluence event happens when several independent forces arrive at the same time, rather than one single cause driving the market. In this case, 4 separate developments are converging within days of each other. Inflation data is set to be released. Geopolitical tension involving Iran is escalating. Physical gold and silver markets, particularly on the COMEX exchange, are showing unusual stress. And China, the world's largest buyer of physical gold, has made a move that is drawing attention from central banks and institutional investors alike. History shows that when multiple forces like these line up together, the resulting price action tends to be more significant and more lasting than a move driven by a single headline. A single news story can push a price up for a day or two before the market forgets about it. But when currency policy, geopolitical risk, and physical supply pressure all point in the same direction at once, the resulting trend often continues far longer than most people expect. This is an important distinction for anyone trying to understand what is happening right now. Short-term traders often react to the price candle on their screen without asking why it moved. Long-term investors, by contrast, study the structure behind the move. They ask whether the breakout is supported by real fundamental pressure, or whether it is simply speculative buying that will fade once the excitement dies down. The early evidence suggests this breakout carries real structural weight. Trading volume during the move was notably high, suggesting that large institutional players, not just retail traders, were active in the market. At the same time, physical demand indicators, including buying activity out of Asia, have remained firm even as prices climbed. This combination, rising price alongside strong physical demand, is historically a sign of a genuine shift rather than a temporary spike. For the business community and for young entrepreneurs building their understanding of macroeconomic cycles, this moment offers an important lesson. Markets rarely move in a straight line, and headlines alone rarely tell the full story. The real skill lies in identifying when multiple forces are aligning, because that alignment is often the earliest and most reliable warning sign available before a larger economic shift takes hold. What happened this week in the silver and gold markets fits that pattern closely. It is not simply a breakout. It is the visible surface of 4 deeper stories, each one worth understanding on its own. The inflation report due this week will shape short-term expectations around currency policy. The situation involving Iran carries consequences that extend far beyond the price of oil. The stress showing up on the COMEX exchange points to a physical market under real pressure. And China's latest move signals a shift in how the world's largest economies are positioning themselves for what may come next. Each of these threads will be examined in detail in the sections that follow, beginning with the inflation data that markets are watching most closely this week. Every month, one economic report has the power to move markets more than almost any other release on the calendar. That report is the Consumer Price Index, commonly known as CPI. This week, all eyes are on the latest CPI numbers, and for good reason. Behind the simple headline percentage lies a much deeper story about the health of the currency itself, and that story matters far more than most casual observers realize. On the surface, CPI measures how much prices for everyday goods and services have changed over the past year. A grocery bill, a rent payment, a tank of gas, all of these are folded into one number that economists and traders watch closely. But for anyone serious about understanding gold and silver, CPI is not just about the cost of milk or bread. It is a direct window into how much value the dollar is losing over time. There are two ways this data plays out, and understanding both is essential. The first is the short-term reaction. When the CPI number is released, markets often move within seconds. If inflation comes in higher than expected, traders quickly assume the Federal Reserve may need to keep interest rates elevated for longer, or even raise them further. Higher rates tend to strengthen the dollar in the short run, which can put temporary pressure on gold and silver prices. If the number comes in lower than expected, the opposite tends to happen, with expectations shifting toward rate cuts, a weaker dollar, and often a boost for precious metals. This is the noise that dominates headlines and social media chatter on release day. But analysts who take a longer view understand that this short-term reaction, while important to watch, is not the real story. The real story is what happens to purchasing power over years and decades, not over a single afternoon of trading. This is where the second, deeper layer comes into focus. Even when monthly inflation numbers look modest, the cumulative effect over time is enormous. A currency losing just 3 or 4% of its value each year does not sound alarming in isolation, but compounded over 10, 20, or 30 years, that steady erosion adds up to a dramatic loss of purchasing power. Money that could buy a certain amount of goods decades ago now buys only a fraction of that same amount today. This is not speculation. It is simple mathematics applied over time. Gold and silver have historically served as a hedge against exactly this kind of erosion. Unlike paper currency, which can be created in unlimited quantities by central banks, the supply of physical gold and silver is limited by what can actually be mined from the earth. This scarcity is precisely why, across centuries and across different economic systems, these two metals have consistently retained value, even as various currencies around them lost purchasing power or collapsed entirely. This is why serious investors do not simply watch the CPI print and react emotionally to a single number. They study the trend. They look at whether inflation is proving sticky or temporary, whether central bank policy is likely to stay restrictive or shift toward easing, and how these dynamics interact with the broader currency system. A single month of data means very little on its own. A pattern building across many months carries far more weight. This week's CPI release should therefore be viewed through that wider lens. Whatever the number turns out to be, the more important question is what it signals about the direction of monetary policy in the months ahead, and what that direction means for the value of money itself. For those building wealth strategically, inflation data is not simply background noise to check off a calendar. It is one of the clearest windows available into the slow, steady story of currency debasement. A story that connects directly to why gold and silver continue drawing serious attention from investors around the world. That currency story, however, does not exist in isolation. It is now colliding with a separate and equally urgent development playing out thousands of miles away, one that carries its own weight for markets watching closely this week. While inflation data tells one part of the story, it is far from the only force shaping the gold and silver markets this week. Thousands of miles from Wall Street, developments involving Iran are once again drawing the attention of traders, analysts, and policymakers alike. For those unfamiliar with how geopolitics connects to precious metals pricing, the link may not seem obvious at first. But history shows this connection runs deep, and it plays out in fairly predictable ways. Iran sits near one of the most important shipping corridors on the planet, the Strait of Hormuz. A significant portion of the world's oil and natural gas passes through this narrow waterway every single day. Any escalation involving Iran, whether military, diplomatic, or economic, immediately raises questions about the safety and stability of that shipping route. When markets sense even the possibility of disruption to global energy flows, the reaction tends to be swift and widespread, touching oil prices, currency markets, and yes, precious metals as well. This is where the concept of a geopolitical risk premium becomes important. When uncertainty rises in a region tied to global energy supply, investors around the world often shift a portion of their capital toward assets seen as safe havens. Gold has held this role for centuries, valued not for its industrial use, but for its ability to preserve wealth during periods when trust in governments, currencies, or global stability comes into question. Silver, while also benefiting from this safe haven demand, carries an added layer of complexity due to its heavy use in industrial applications, something that will be examined more closely later in this analysis. What makes the current Iran situation particularly worth watching is not simply the headline itself, but the pattern surrounding it. Analysts who study these cycles closely note that geopolitical tension rarely resolves quickly or cleanly. Instead, it tends to move in waves, with periods of escalation followed by periods of quiet negotiation, only for tension to resurface again later. Each wave adds another layer to what traders call the risk premium already built into gold and silver prices. This distinguishes short-term volatility from long-term structural risk. A single news headline about Iran might cause prices to jump for a day or two before settling back down once initial fears ease. This is the kind of reaction that dominates short-term trading screens and social media commentary. But when tension becomes a recurring, unresolved feature of the geopolitical landscape rather than an isolated event, it stops being simply background noise. It becomes a structural input that markets factor into pricing over the medium and long term. This is precisely the pattern many analysts believe is unfolding now. Rather than a single flashpoint that quickly fades from memory, the situation involving Iran represents an ongoing source of uncertainty that continues resurfacing in different forms, whether through shipping disruptions, sanctions activity, or diplomatic breakdowns. Each fresh development adds another layer of caution into how institutional investors approach their portfolios, often leading to increased allocation toward gold and silver as a form of insurance against events that are difficult to predict with any real precision. For the business community and young entrepreneurs trying to understand these dynamics, the lesson here extends beyond any single country or conflict. It is a reminder that markets do not operate in isolation from world events. Energy security, shipping routes, and regional stability are all deeply interconnected with the value of currencies and the assets people turn to when confidence in the financial system wavers. Understanding this connection is not about predicting the next headline. It is about recognizing that persistent geopolitical uncertainty tends to build a floor under precious metals prices over time, regardless of how any single news cycle plays out. This growing geopolitical premium, however, is not developing in a vacuum. It is unfolding at the very same moment that a separate and equally significant story is building inside the physical gold and silver markets themselves, one centered on exchanges, inventories, and a nation whose buying habits are reshaping global demand. Behind every price displayed on a trading screen sits a physical market, one built on actual bars of metal sitting in vaults, warehouses, and exchange-approved facilities around the world. This week, that physical layer of the gold and silver market is showing signs of real strain, and analysts studying exchange data closely say the pressure building beneath the surface deserves far more attention than it typically receives. At the center of this story sits COMEX, the primary exchange in the United States where gold and silver futures contracts are traded. Most participants on COMEX never intend to take physical delivery of metal. Instead, they trade paper contracts that represent claims on gold and silver, settling positions in cash long before any actual bar changes hands. This system works smoothly under normal conditions, but it depends on one critical assumption, that only a small fraction of contract holders will ever demand the physical metal underlying their positions. Recent data suggests that assumption is being tested. Reports of tightening inventories, rising delivery requests, and unusual movement of metal between exchange-registered categories point to a market where the gap between paper claims and available physical supply is narrowing. When this gap becomes visible, it tends to unsettle traders who understand exchange mechanics, because it raises a fundamental question: what happens if a large number of contract holders decide they want the actual metal rather than a cash settlement? This is not simply a technical curiosity confined to trading desks. It connects directly to a much larger global story, one centered on China. Over recent years, China has emerged as one of the most consistent and aggressive buyers of physical gold anywhere in the world. Central bank purchases, expanding domestic gold exchanges, and rising demand from Chinese consumers have combined to pull enormous quantities of physical metal out of Western vaults and into Eastern hands, often permanently. This shift matters because it represents more than simple buying activity. It reflects a broader strategic move by China and other nations to reduce reliance on the US dollar as the anchor of the global financial system. Gold, unlike currency, cannot be created by a printing press or devalued through monetary policy decisions made in another country. By accumulating large physical reserves, China and similar nations are positioning themselves for a financial landscape where trust in paper currencies, including the dollar, may no longer be taken for granted. The interaction between these two forces, tightening COMEX inventories in the West and steady accumulation in the East, creates what analysts describe as a structural supply imbalance. Western paper markets continue operating largely on the assumption that physical metal will always be available when needed. Meanwhile, physical metal is steadily flowing toward economies that show little interest in returning it to circulation. Over time, this dynamic places increasing strain on a system built for decades around the opposite assumption that physical demand would remain modest and manageable. For serious investors, this is where the deeper significance of the current breakout becomes clear. A price move driven purely by speculation tends to be fragile, prone to reversing once trading enthusiasm fades. A price move supported by genuine physical scarcity tends to behave very differently, often proving far more durable because it reflects a real imbalance between supply and demand rather than short-term sentiment. For the business community and young entrepreneurs studying these patterns, the lesson extends well beyond gold and silver themselves. It illustrates how physical realities, actual bars of metal sitting in actual vaults, ultimately shape financial markets in ways that paper contracts and trading screens can only reflect, not control. When physical supply tightens, while demand from major global economies continues rising, the resulting pressure does not simply disappear. It builds, often quietly, until it becomes impossible to ignore. This is precisely the position gold and silver markets appear to occupy at this moment, caught between a Western paper system showing early signs of strain and an Eastern buying pattern showing no signs of slowing down. What this convergence ultimately means for the months and years ahead is the subject that ties together everything examined so far. 4 separate stories have now been examined in detail, and each one carries real weight on its own. But the true significance of this moment does not come from any single thread. It comes from the fact that all 4 are unfolding at the same time, reinforcing one another in a way that history shows does not happen often. The breakout itself was the starting point. Silver and gold moved sharply higher, and rather than being dismissed as a random price spike, the move showed the hallmarks of something more structural, supported by strong trading volume and firm physical demand, rather than short-lived speculation. That alone was worth watching closely. Then came the inflation data. The CPI report due this week is not simply a monthly headline. It is a window into how quickly the dollar is losing purchasing power over time, a slow and steady erosion that compounds year after year. Whether the number comes in high or low, the broader trend of currency debasement continues to push long-term investors toward assets that cannot be printed into existence. At the same time, tension involving Iran added a second layer of pressure. Rather than a single event that fades quickly from memory, this situation reflects an ongoing source of instability tied to one of the world's most critical energy corridors. Each new wave of tension adds to the risk premium already built into gold and silver, reinforcing their role as insurance against events that are difficult to predict. Finally, the physical market itself told perhaps the most important part of the story. Tightening inventories on COMEX, combined with China's continued accumulation of physical gold, revealed a widening gap between paper claims and actual available metal. This is not simply a trading detail. It reflects a deeper shift in how major economies are positioning themselves for a future where confidence in traditional currency systems can no longer be assumed. When these 4 forces are viewed separately, each one offers a partial explanation for what is happening in the market. But when viewed together, a clearer picture emerges. A currency losing value, a region carrying persistent geopolitical risk, and a physical supply system under real strain rarely align by coincidence. Analysts who study long-term market cycles note that moments like this, where monetary, geopolitical, and physical pressures converge simultaneously, have historically preceded periods of significant and lasting price movement rather than short-term noise. This does not mean predicting the future with certainty. No serious analyst claims to know exactly how these events will unfold in the weeks ahead. What can be said with confidence is that the conditions currently in place carry historical weight, and dismissing them as unrelated headlines would overlook the deeper pattern connecting them. For the business community, and for young entrepreneurs building their understanding of how global markets actually function, this moment offers a valuable lesson in disciplined thinking. Reacting emotionally to a single day's price movement rarely leads to sound decisions. Understanding the forces building beneath the surface and recognizing when multiple signals point in the same direction is what separates strategic positioning from simple speculation. Gold and silver have played this role for centuries, not because of hype or promotion, but because they have consistently proven their ability to preserve value when currencies falter and uncertainty rises. What is unfolding right now fits squarely within that long historical pattern, and the coming weeks are likely to reveal whether this convergence marks the early stage of a much larger shift already taking shape. Currency Arc Insight will continue tracking each of these developments closely, breaking down the data as it emerges and separating genuine signal from short-term noise. For those serious about understanding where the global economy is heading, this is a story worth following far beyond a single headline.